Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of why structured investment vehicles matter in modern finance. Structured investment vehicles, SIVs, a clear guide to their purpose, risks, and benefits. Structured investment vehicles, SIVs, play a unique role in the financial world. These entities are designed to purchase and manage assets, often with the aim of generating steady income for investors. By using short-term funds to invest in longer-term securities, SIVs operate in a way that balances risk and reward. But how do they work, and why are they important? Understanding their purpose and potential risks is key to grasping their place in modern finance. What are structured investment vehicles? Structured investment vehicles, SIVs, are specialized financial entities designed to operate within the world of asset management. They serve as intermediaries, bridging the gap between short-term borrowing and long-term investing. By borrowing funds with lower interest rates and investing in higher-yield securities, SIVs aim to generate significant returns for their stakeholders. But what exactly are their purpose and features that set them apart? Let's break it down. Definition and purpose. SIVs are entities created with the goal of making a profit from the spread between borrowing and investing. Think of them as financial machines designed to take advantage of the difference between short-term and long-term interest rates. Here's how it works. An SIV raises money by issuing short-term debt, like commercial paper, to investors. Then it uses that capital to purchase long-term assets, such as mortgage-backed securities or corporate bonds, which typically offer higher yields. The profit comes from the interest collected from these long-term assets, minus the cost of repaying the short-term debt. SIVs operate outside the balance sheets of traditional banks, making them part of the so-called shadow banking system. This separation minimizes direct risk to banking institutions while allowing investors to access higher returns. But with potentially higher rewards also comes greater responsibility in risk management, a critical aspect of how these vehicles function. Key characteristics of SIVs. What makes SIVs different from other investment vehicles? It comes down to a few distinct features. Capital arbitrage. SIVs capitalize on the spread between short-term borrowing costs and long-term investment returns. This is their core strategy. Off-balance sheet structure. By operating independently of banking institutions, SIVs avoid regulatory constraints that apply to traditional banks. This allows flexibility but also comes with fewer safeguards. Highly leverage. SIVs often rely on significant amounts of borrowed money to fund their investments. Leverage amplifies potential gains but also increases exposure to market risks. Asset diversification. SIVs usually invest in a wide range of securities, including mortgage-backed assets, corporate bonds, and other high-yield instruments. This helps spread risk, though it doesn't eliminate it. Dynamic management. These vehicles are actively managed to adjust for changes in interest rates, asset values, and market conditions. Skilled management is critical to their success. Understanding these characteristics helps explain why SIVs can be both attractive and risky. They're designed for investors who are comfortable balancing the potential for high returns with the possibility of significant loss. How SIVs work. Structured investment vehicles, SIVs, are built around a simple yet strategic financial formula. Raise funds at a low cost and invest in higher yield assets. They rely on short-term borrowing combined with long-term investment strategies to generate profit. But what keeps them running smoothly? Understanding their approach to funding, investment, and risk management is essential. Funding and investment strategies. SIVs start by raising capital through short-term borrowing, such as issuing commercial paper or medium-term notes to investors. These debt instruments typically have lower interest rates, making them a cost-effective way to secure funding. Think of this as the foundation that supports everything else they do. Once the funds are raised, SIVs channel them into long-term investments that offer higher yields. These investments often include mortgage-backed securities, corporate bonds, asset-backed securities, government bonds. The goal is simple: earn more from these assets than what it costs to borrow the funds. This difference, known as the interest rate spread, is where SIVs generate profit. To maintain profitability, SIV managers actively shift their portfolio based on market trends. For example, if yields on mortgage-backed securities drop, they might pivot toward higher return corporate or asset-backed bonds instead. This flexibility allows SIVs to adapt and stay competitive in changing market conditions. Asset management and liquidity risks. Managing the portfolio is one of the most critical aspects of operating an SIV. These vehicles rely on active portfolio management to optimize returns while balancing risk exposure. However, their structure introduces unique challenges, particularly around liquidity risks. Why is liquidity a concern? SIVs borrow money over short durations but invest in assets that take longer to mature. This timing mismatch creates liquidity risk, the possibility that the SIV can't roll over its short-term debt fast enough to cover maturing obligations. If market conditions tighten or investor sentiment shifts, this risk can escalate quickly. To address this, SIVs often maintain liquidity buffers, such as cash reserves or highly liquid assets, to cushion against funding gaps. Some also diversify their funding sources by using different types of debt instruments to avoid over-reliance on any single type of investor. Even with these precautions, managing liquidity is a constant balancing act. A sudden drop in asset values or a credit downgrade can disrupt their ability to raise funds at favorable rates, putting their operations under pressure. In many ways, SIVs operate like tightrope walkers. Success depends on striking the right balance between risk, reward, and market stability. Without careful asset management and liquidity planning, they risk tipping too far to one side. Types of SIVs. Structured investment vehicles, SIVs, come in different forms, each with its own structure and focus. These variations cater to different investor goals and levels of risk tolerance. Understanding the types of SIVs is essential to decipher how they operate and why they're structured the way they are. Traditional SIVs. Provide insights on traditional SIVs and their market presence. Traditional SIVs are the original model in the world of structured investment vehicles. These entities were designed with a clear-cut strategy. Use short-term debt to fund investments in high-yield, long-term assets, such as mortgage-backed securities, asset-backed securities, and corporate bonds. Their main goal was to profit from the spread between short-term borrowing rates and the returns on their long-term investments. Traditional SIVs are characterized by their complex management structures, which required active oversight to manage liquidity risks and maintain profitability. They employed highly skilled financial managers to monitor and adjust portfolios based on market conditions. Market presence was robust during the earlier part of this century, with traditional SIVs attracting institutional and individual investors interested in higher returns. However, their reliance on short-term debt created a vulnerability. During the 2007-2008 financial crisis, many traditional SIVs experienced a liquidity crunch, as they could no longer roll over their short-term debt to meet obligations. This led to significant setbacks, causing their popularity to dwindle. Key features of traditional SIVs include highly leveraged structures that aimed for high returns, a diversified portfolio of long-term securities designed to spread risk, heavy reliance on issuing commercial paper as the primary funding mechanism. Although traditional SIVs have largely faded from prominence, they laid the groundwork for modified structures used today. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.